Hello everyone, welcome back to Just Invest. Today, in today's video, I want to talk about a 1970s article in Business Week called The Death of Equities. Yes, an article came out stating the death of equities. This was back in 1979 when this guy came out and published this article, and it was crazy because I want to revisit this because we're in a bear market. We see the S&P down 21% year to date. So we're officially in a bear market. There's craziness in the market. We have so much things going on. With increased oil prices, we have inflation taking over, we have a higher interest rate environment. And if we look back to the 1970s, we can kind of see the same things taking place. And this is exactly when Warren Buffett kind of got out of the market. He thought things were too expensive. He pretty much entered back in 1973-74 when the market took a huge crash. And this is what we're seeing in today's market, the same kind of sentiment, the death of equities, in my opinion, because no one wants to invest in the stock market at this point. People are afraid, they're scared because of the same things that were happening in the 1970s. So I want to go through that article in Business Week, and I want to show you what they were saying back then, which was proven to be false. As you've seen, equities have been doing amazing. But during that time, we have to admit, gold was doing amazing, commodities was doing really good. The equities weren't doing really amazing during that time period. So let's look back and see what we can learn from the 1970s and see if we can apply any of that knowledge today. So I'm going to go through this article and talk about his main points on why he thinks it's the death of equities. So how inflation is destroying the stock market. So basically in the first paragraph, he talks about how pension funds have a more free range. They can invest in high-grade bonds. They can invest in gold and real estate, in small businesses, in different types of companies and foreign companies. They can do a lot of different things with the money. And this was all started in 1974, when the act kind of made it more liberal for you to do different things and had a different interpretation of what you can do with your money. It didn't have to be in a straight and narrow way with pension fund money, and that happened with the Labor Department. In this next section, they talk about how the institutions are basically running the stock market. 7 million shareholders have left the market. All these small shareholders are just leaving. Only the elderly remain. And I'm not sure if this is sufficient today, as a lot of people are still buying the dip in dollar cost averaging as they gotten smarter, but still institutions run the market. It's like 80-90% of the money. And what do we see today? Institutions are going to energy, they're going to oil, and kind of more financials, more stable places to put your money. And that's what's going to be continuing going on because they're trying to find ways to beat inflation. So that's another big thing that we have to maybe worry about in the short term. And that's why he thinks the death of equities was here to stay, as institutions have more free range to invest in different types of assets like gold, like commodities, like diamonds, anything else. As it is, the nation's financial markets and capital flows have been grossly distorted by 13 years of inflation. Before inflation took hold in the late 1960s, the total return on the stocks had averaged 9%. So that's what we've been averaging for more than 40 years, while AAA bonds, infinitely safer, really paid more than 4%. Today, the situation has reversed, with bonds yielding up 11% and stocks averaging a return of less than 3% throughout the decade. So can we see that happening? Stocks averaging less than 3%, which would be crazy. If bonds are averaging 11% and stocks are only averaging 3%, why would anyone buy stocks? Is that a possible scenario into the future? Because that's what's been happening during that time in the 1970s, 60s. As a result, even institutions that have far remained in the financial markets are pouring money into short-term investments such as alternate equity investments as mortgage-backed paper, foreign securities, venture capital leases, guaranteed insurance contracts, index bonds, stock options, and futures. At the same time, individuals who are not gobbling up hard assets are flocking money into market funds to nail down high rates, or into municipal bonds to escape heavy taxes on inflated incomes. Few corporations can find buyers for their stocks, forcing them to add debt to a point where balance sheets seem permanently out of whack on Wall Street. The flight from stocks has forced firms to push alternative investments hard, thereby drawing still more money from the stock market. And this is what's happening. People are trying to find yield in this market. Like, if your stocks are not going to average 8 to 9%, into the future while that's what's happening with inflation, then it's just a bad bet right now. So people are trying to find higher yields, and they're gonna find it anywhere they can. And oil, energy, it's been kind of booming because they think they can find higher yields, and that's what's been going sky high. People no longer think of stocks as an inflation hedge, and based on experience, that's a reasonable conclusion for them to have reached. Since 1968, according to a study by Salman Bros, stocks have appreciated by a disappointing compounded annual rate of 3%, while the consumer price index has surged 6.5%. By contrast, gold grew by an incredible 19%, diamonds by 11%, single-family housing by 9%. People were running away from equities. Pension funds were allowing people to put their hard-earned money in different asset classes, which came to the thinking that people would not return back into stocks. To sum up this whole article, basically everyone was leaving the equity markets. People were afraid to invest in stocks because of inflation, rising interest rates. People were looking at other asset classes to invest in during the 1970s, which was a kind of a reasonable response to what was happening because equities wasn't giving the same returns. It was like 3%, but gold, commodities, real estate, dividend growth companies were all giving higher returns. So do you see the same thing happening in this market that we're in right now? Or do you see for the future that dividends, commodities, gold, real estate is going to do better than equities into the future? In my opinion, I don't think so. What I would do with my money is buy stuff that people are afraid of. One of the main stocks I think that people are afraid of is Facebook, even though it has such a strong moat. It's so cheap right now, and I think it's going to be an incredible growth story moving forward. Tell me what you think about this video, like it, and subscribe. Peace.